As California struggles to close a $24 billion deficit, it could be paying its bills with IOUs starting next week. Now, Fitch Ratings has downgraded all of the state's long-term general obligation debt. The rating is still 4 levels above junk status, but it further highlights the precarious financial position of the state. Just how significant is the move? Paul Brennan joins us now. He is a portfolio manager at Nuveen. He is with us from Chicago with his take. Brennan, by the way, helps to manage $12 billion in muni debt, including that of California. Paul, how surprised are you by the Fitch downgrade?
Not terribly surprised. The state, as you know, has been under intense pressure with their budget. This is just some of a warning shot, if you will, that the state really needs to get something done. The fiscal year is approaching. The end of the fiscal year is approaching.
They run out of money in July, right?
And they're potentially looking at running out of money in July.
So what does this do to your portfolio? I mean, did you anticipate this?
Well, we certainly are expecting continued downward rating pressure on the state. Even if they get this budget gap closed, they're still dealing with a potentially structural budget deficit going forward into the following fiscal year. So I think we're going to continue to see downward ratings pressure on the state of California for quite a while.
And you were prepared for that as far as your investment strategy went?
Yeah, we've been taking appropriate action. We do have exposure to Cal, but I think investors have to be very careful, and we have to follow the situation very closely because there is going to continue to be volatility in the situation, and I think investors need to at least approach it very cautiously.
On a scale of 1 to 10, how likely is it that you think some of these obligations go into default?
We're not expecting the state to default. Obviously, there's going to be pressure, and on the margin, default risk obviously is increasing. But you got to keep in mind that the state is a very large, almost a sovereign-like entity. Debt service is constitutionally a very high priority for the states, and their budget process takes that into account. So we're not really expecting any disruption in debt service from the state.
I know you can't speak for sort of all institutional investors, but what do you think this does in terms of demand from that group of investors? I mean, is A- low enough?
Well, it's going to be interesting to watch. It's going to be hard to tell what's going to happen, but I think the fact that the state is under ratings pressure has raised the yields in the secondary market for California, and that obviously may attract some additional investors who are seeking higher yields. On the other hand, I think the ratings volatility and the pressure on the ratings is going to also scare off some investors. So it's going to be difficult to tell, but I think right now we're seeing a little bit less demand, obviously, because the yield premium on California debt has been rising over the last month.
So as you just highlighted, that could be a good news, bad news front, at least as far as the budget goes, right?
Right, right.
Okay. So what else, aside from California, do you like and do you not like in muni land? I mean, this is an area that has seen a crazy year and a half.
Indeed. There's a lot of areas that we do like, and there's a lot of sectors and spots on the yield curve investors can find some value. But I think essential service type of borrowers, those who are like states, municipalities who issue general obligations or other tax-supported debt, these type of borrowers are somewhat natural monopolies and are very resilient in tough economic times like we're facing now. And they have the ability and the willingness to make their debt service payments and weather the storm fairly well. So we're focusing on a lot of that area, which includes like general obligations, utilities, other types of governmental infrastructure projects that we think will do very well in tough times.
Paul, we thank you. Paul Brennan
from
Nuveen.